Hello and welcome to the Mutual Fund Show. My name is Nirav. In the next 25 minutes, we'll talk all about mutual funds. This time around, we'll talk all about tax-saving funds. We told you 2 or 3 days ago that maybe your HR department wrote to you saying, hey, submit the investment proofs, and you are making a beeline to try and figure out what is it that you can do in order to create this investment proof and invest money well in order to save tax and at the same time build wealth. Well, mutual funds is one option. To a lot of people, this is the best option, but let's not get into the debate of whether this is the best option or not. I'll let my guests say that. But what we'll try and do is that if you're convinced about investing in tax-saving funds, what are the funds that are there? And what are the pros and cons of those? To talk about that, Vishal, founder and CEO at Plan Wealth Advisors, and Nirav Panchmatia, founder and CEO at AUM Financial Advisors, join us on the show. Gentlemen, both of you, thanks so much for joining in.
Pleasure.
I would wonder, though, at the start, just to settle this debate, would you believe that for that 1,50,000 tax saving, assuming that EPAF and other options don't exhaust a person's quantum, are tax-saving mutual funds a really good option or the best option?
So I think they're a really good option. I think the need on whether it's the best option depends on how long people can stay invested. So a lot of people tend to look at each tax option as saying, what's the lock-in? And therefore, let me take the money and get out of it once the lock-in period is over. Now, ideally, if you're going to be doing equities, you don't want to be putting money there only for 3 years. You want to put it there for 7, 10 years, allow them to flourish, go through the market cycles, etc. So our belief is that if you're coming in there saying that this is long-term wealth creation for me, the tax break on top of that is like great news, then I think ELSS is a great category for investors to look at. But if you're coming in there saying, I need the money after 3 years, I'm going to set up a business, I have a children education goal that I need to fund in 3 years, then I think you need to be very careful about just allocating all of your money to equity only.
Okay. Nirav, what are your thoughts?
So, tax under Section 80C, there are a plethora of options. Tax-saving mutual fund or ELSS has a minimum lock-in of 3 years. It is a market-linked product. And the only first criteria for investing in equity is that you should have a minimum 3-year investment horizon. The lock-in exactly matches that particular criteria. From that angle, I think it is one of the better options under all the 7-8 options that you have under Section 80C. And it is the first exposure that a particular investor can have to equity market via that 1.5 lakh per investor in his family per income tax file that he can take to tax-saving mutual funds. So I think that is one option. It's a no-brainer. One should always, one should let go of PPF now, because at 7.9% it is barely matching inflation, and look to investing in a tax-saving mutual fund.
Okay. Keep in mind, I think what Nirav means by it being the first option is not that that is by mandate. Yeah. It is just that tax-saving funds probably give you the first entry point because you also save tax and at the same time get exposure to equities as well. The reason I'm saying this because a lot of CEOs and fund managers who come in on the show say that you should start off with the balanced advantage fund category or so on and so forth. So just to clarify what Nirav's point is. Now, let's work with an assumption that people are agreeing to this argument that tax-saving funds are a good option to invest in. What are the funds that people could do in? And we'll then also talk about the benefits of a tax-saving fund, not just for the purpose of saving tax, but for building wealth as well. But first, let's stick to the topic at hand, which is tax-saving funds. And let's talk about a few funds that you guys have in your mind, and why is it that you're recommending that? I think the number one and number two between the two of you alter a little bit in terms of positions, but Axis, they've had a fabulous last 12 months, and therefore I want to start off with that. It is your number one option. Why so?
So I think one needs to go back in history a little bit to be able to separate out what's happened in the last 12 months versus just a long-term track record, because I think 12 months is too short to really go out and make decisions on investment choices. So I think there are 3 things that have worked well for Axis. One is the fact that they've been true to their mandate of being able to be flexible to move across market caps. So if there have been times where they felt that the large cap universe looked more attractive, they've stayed there. If they felt that mid caps are a good place to be in, they've been fairly comfortable in moving that portfolio there. So I think staying true to mandate and taking advantage of it is definitely a good reason. The second is they've had a very stable management team, and I think that's important because ultimately, while processes will drive certain outcomes, I think fund managers and fund management teams actually add that extra level of benefits that really flow through to investors. The third is just the fact that they've run concentrated portfolios, and over the last few cycles, we've actually seen that concentrated portfolios have actually helped outcome if you've got the choices right. And therefore, I think the combination of these three things have actually helped. Now, as you look at the data today, you might get a little worried because you're starting to see valuations on that portfolio being at a premium to other players. And therefore, I think it's very, very important when people are making ELSS choices that they go in through either SIPs or STPs, very much like they would do with other investments.
Okay.
Otherwise, you could end up entering a market at just the wrong time. Let's say, if you're getting into markets today, it's very tempting to just say, I got to give that investment proof by Feb 28, so let me just get it out of the way right now. And you miss the fact that you could have actually at least put maybe 2 or 3 different installments. You could have spread it out over the next 45 days or so, and then given your investment proof still by Feb 28.
Yeah.
So I think I at least start in April, build it out for 12 months. If you can't do that today, then just at least for the next 45 days, if your company allows it, do that.
Yeah, but actually for a lot of people, the proofs have to be submitted even earlier than Feb 28 for those, just to ensure that the end of the month income doesn't change too much. I think one sound advice that came in from this is also that let's assume you're in this moment of rush of trying to make sure that you meet your timelines given by your HR for right now. Start an SIP from April onwards for the next financial year, so that a lot of your tax saving portion is taken care of, and you don't have to watch this show again next year to try and figure out what to do. Nirav,
Sure.
your top recommendation is the Mirae Asset Tax Saver Fund.
Right.
Now, why do you like this one?
So look, Mirae as a fund house has proven its mettle in Indian equity market. So the fund house, the pedigree that they have, the scheme and the fund manager Nilesh Surana. So they've got an impeccable pedigree and impeccable performance over the 4 years that Mirae Tax Saver has been. And as Vishal pointed out, Axis long-term equity by far over 3 and 5 and 10-year period has been the best performing fund. But that is exactly because of those 11 stocks which are running the market today, right? So today that particular portfolio is slightly overvalued. Although if you want to buy, I would say if you want to buy the best stocks that are there in the Indian equity market, Axis long-term equity is the one you should start with. So I would, rather than going for the first rank and the second rank, I would say the top 3 picks in top tax saving mutual fund from my side would be Mirae Tax Saver, Axis Long Term Equity, and Parikh Tax Saver. The third one does not have a track record because it's a new fund, but the particular mutual fund company has an exemplary track record.
Sure.
And this is only the second offering from that particular AMC.
Okay, we'll get to that as well, which is the third one that you're saying. But so you don't have a particular choice between Mirae and Axis. Your call is similar on both the
You
funds.
bid your money. So let's say if you want to invest 1.5 lakh, why don't you put 75,000 each in both Axis Long Term Equity and Mirae Tax Saver? Let's not go by who, because the top ranker of the class changes every year. So let's not go by that. Again, in the 4 or 5 offerings that we have in tax saving mutual fund that I have selected, if you think you have a bias towards mid cap, then you as well go for a Motilal long term equity.
Sure, and we'll get to the other offerings. But right now, we're talking about the first one and two.
Mirae, whichever equity fund Mirae Fund House has come out with, they have limited 4 or 5 equity funds. They have been the top quartile performer in each of the category. Again, this is a fund with a large cap bias. 75% is invested in large cap as of now. Considering the times and the geopolitical risk that we have, I think large cap bias is preferred during these times rather than going right away for a mid cap and a small cap.
Okay.
And I'd like to add a point on your SIP thing. One thing one has to remember, there's a 36-month lock-in, right? From the date of your investment in a tax-saving mutual fund, SIP is 100% recommended if you do a 12,500 SIP every month. In a tax saver, you meet your 1.5 lakh, as you rightly pointed out, and that way you're not burdened in the month of February and March. While you have to give your documents to the HR person, that suddenly you have to find out where you can take out that 1.5 lakh. But one has to remember, each SIP is locked for the next 36 months.
Yeah.
So when you're going to redeem it after a 3, 4, 5 year period, it will take 2 more years for you to redeem the entire amount.
Yeah.
One just has to be aware of it. Otherwise, SIP in a tax saving mutual fund is a wonderful proposition.
Yeah, the other way to look at it is that instead of you investing your 1.5 lakhs in January of 2020, if you had done this starting April 2019, your 9 installments would have that much of a lesser lock-in. However, lock-in is a conversation that goes into a completely different tangent simply because we are all saying that equities are out here for a long-term investing perspective, and therefore don't think of 3 years, think of this more. And the point, I'll get to that point as well immediately after this, but since he spoke about Mirae tax saver as one of his recommendations, and I believe, unless I'm very wrong, it is there in your list as well, Vishal.
Yes, it is.
Do you want to add to why you prefer Mirae as well?
So I think there's one big driver. So what has happened with Mirae is that it isn't as concentrated a portfolio amongst those big names. I mean, to contrast it, Axis, for example, has 65% of its portfolio in the top 10 names, and therefore, if that bucket underperforms for whatever reasons, I think investors will be exposed to that particular risk. Mirae is much more diversified. If you look at valuations as well, they're pretty much in line with category, they're in line with index. So we like the fact that it works well. And what we continue to always like is everyone who's doing bottom-up stock picking. I think we are in a market which is going to be a bottom-up stock picking market for a while, because the macro is not supportive. There are loads of issues in there. So I think the more we are able to identify bottom-up stock pickers, I think the more likely that your outcome is going to be positive.
Okay. Now, before we get to the next funds, just a very quick conversation. Why tax saving funds need not be only used for tax saving, but also for wealth creation? And quick points out here. Nirav, you want to start off with this, that don't just look at it from a tax saving perspective.
So tax saving fund at the end of the day are equity diversified funds. And most tax, so we have around 42 offerings in tax saving. So they are just like any other tax saving fund. The only thing is they have an additional benefit given by income tax department under section 80C that if you invest there, you also get a tax benefit. So I mean, this is a myth. We get called from investors at the end of the 3rd year. Tax saving period is over. Can we redeem? You wouldn't have redeemed if it was a normal equity diversified fund and you had tagged that particular fund to a particular goal. So my suggestion would be invest in tax saving fund, mutual fund to get a tax benefit, which is a secondary benefit that you are getting. But don't forget it is an equity diversified fund. And if it is doing well, tag it to your goal and you can renew your investment at the end of 3 years rather than taking out money. It is only a liquidity available to you. The lock-in is over. But if the fund is doing well, another advantageous point is that after 3 year period, you can revisit, re-strategize. If the fund is not doing well, you can move to other tax saving mutual fund or other normal equity diversified fund, which is not an option available under other ATC options. So in PPF, I am locked for 15 years with a partial withdrawal in the 7th year. In an NPS and bank FD, I am locked for 5 years. Right after I've invested, if the interest rate goes up, I cannot re-strategize. Here I can do that.
Okay.
So don't look at tax saving funds at 3-year product. They can be a 30-year product also.
Okay. Vishal, you want to add to this?
So I think there are 2 elements here. One is, what phase of life a particular investor is in, and I'm going to give you an example. So there is a set of people who are always unable to get ends to meet because they're leveraged, all of that. And tax is really the only thing that drives them to save some money. And I think if that's the bucket that you're in, the lock-ins are actually very, very useful because they kind of prevent you from spending that money off, which can be much more damaging. Here we're talking about potentially losing 10-20% of your capital. If you spend it off, you've lost all of it. So I think it's important to be able to separate out a set of people who have surpluses, disciplined. I think for them, a tax planning fund can very well serve as a long-term wealth creation instrument amongst their bucket of other funds that come in there. And therefore, they need to get evaluated just like one would evaluate, let's say, if you're looking at a multi-cap ELSS fund, you need to look at it against other multi-cap funds in there. The lock-in has an advantage for first-time investors because if they're going to end up panicking because of market situations, which happens very often, you look at your screen and your 150,000 and suddenly become 135,000 and you're like, before it becomes 100,000, let me run. I think for those set of people, it's also good that the lock-in prevents them from panicking. So I think those set of investors will find a lot of value in using ELSS funds as a general wealth creation vehicle. I think for the other set of people who are always short of money, I think it's a forced discipline tool. I think in fact, we tell those investors that don't even run a 1-year SIP, run a longer term SIP. Ultimately, if you want to stop it, it's like it's a 1-month affair. But if I come back to you next April and tell you, let's start the tax planning fund again, you're probably going to think that, oh, you know what, I'm going on a vacation in May, I'm going to spend this money in July, and so on and so forth. So I think there are these two different sets of investors who may look at this vehicle very differently from each other.
Okay, so multiple things, behavioral as well as otherwise, which might help. Even from a fund management perspective, having that lock-in allows that fund manager to probably plan the investments in a better fashion. And all of those things might actually work. Okay, but back to the topic. Viewers, you've gotten two fund ideas. Let's talk about some of the others too. You have anyways read some of these on the screen. Nirav, I want to come to you.
Sure.
You mentioned PPFS, but the list says that you have Motilal Oswal long-term equity fund as one of the ideas as well. You want to talk about that?
Yeah. So Motilal Oswal, so amongst the many tax-saving offerings that we have, 40 odd, Motilal stands out in a way that it is a concentrated portfolio. There are only 26 stocks in the portfolio. So if an investor wants to take a tax advantage, go for an equity diversified multi-cap fund, and wants to have a concentrated portfolio, aka PMS, Motilal is a very good offering. They follow a growth at reasonable price GARP strategy. And earlier the fund, although being multi-cap, was tilted towards large cap. Now it is tilted more towards mid-cap, considering the valuation that we have, the attractive valuation that you have towards mid-cap. So from that angle, and you have a Ramdev touch to that portfolio. I never forget to mention that. So I would think a Motilal long-term equity stands in a good state today if you put money there for the next 3 years.
Okay. It's there in Vishal's list, but I want to talk about the number 3 fund on Vishal's list. And again, Aditya Birla Sun Life Tax Relief 96 Fund. Why this one?
So it's pretty interesting because if you look at their 1-year performance, they're actually lagging pretty significantly. So for people who sought on returns, this would kind of not appear in the top maybe 10, 15, 20. So I think we continue to believe that one of the ways that investors need to look at returns is to look at them on a rolling basis rather than on a trailing basis. And I'm sure you've covered this on the show before, but I'm just going to, maybe spend a minute on it just so that, viewers can look at it from the way that we look at it. So one of the clear biases that exist is that the last 12 months performance will impact your last 24-month performance, 36, 48, 60, and so on and so forth. And therefore, if you have to remove that bias, saying that, is my last year's great performance or terrible performance impacting all my past outcomes, then the only way to beat that is to use rolling returns. And very interestingly, when you put Birla Tax Relief 96 on a rolling return parameter, you will find that it actually scores very highly. The second thing is to understand the reasons why they have underperformed, and in the last 12 months, for example. And you'll find that one of the big reasons is a fairly significant position on the mid-cap side. So it's not like they're a mid-cap heavy fund, but they have much more than what their peers have. And therefore, when you look at it on a peer group basis, you are seeing them underperform. So we're saying that if we can look at a good fund management team, if we believe that mid-cap valuations are now as attractive or as good as large-cap valuations, then a portfolio which is having a mix which is a blend of both of them is more likely to give investors a better outcome than one which has only large-cap exposure. And that's the reason why we continue to believe that it's a good choice, even though there is a 1-year underperformance.
Okay, so on a rolling return basis, it's a good choice as per Vishal. The next fund that we have is from Nirav, and that is the Invesco India Tax Plan. Is the strategy different as to why do you like it?
So Invesco India Tax Plan is managed by Amit Ganatra. Right, this is the, normally in today's time, you'll see 95% of the equity funds have a bias. The top sector is financials. The second top sector is consumer, right? So, I mean, if you have other equity funds in your portfolio, you are anyway overweight on all these two particular sectors. Invesco India Tax Plan is one fund which is overweight on industrials and healthcare today, because those two sectors are. So this fund follows a contra approach, right? And it has not done extremely well over the last 1 year, because financials and consumer had done well last year. But if you look at the next 3 years, 5 years, I believe this contra approach will pay off in a big way.
You're taking a bit of a sectoral call here.
I'm taking a sectoral call. So this is other funds a bottom-up approach. They take a sectoral approach first, and they've consciously taken a decision that let us not be very heavy like the Sensex and Nifty and other equity funds on financials and consumer. Let us be underweight there and overweight on industrial and healthcare. And that is the primary reason I've chosen this fund.
Okay, so going contra, and that is probably adding that bit of flavor for Nirav Panchmatia in the portfolio. Interestingly, the DSP tax saver fund finds the mention, Vishal. Why this? Because I see your reasons that it ranks better than its peers on multiple parameters.
Yeah, so the way we look at funds again is that we need to be able to find consistent performers, because the challenge that one always sees when one is trying to do fund selection is that you see this wide variation in performance in 1 year, and then spectacularly good one followed by a spectacularly bad one, and so on and so forth. And therefore, if you're trying to look for consistent players, which is what I think a lot of investors want. Everyone would love to have the best performing fund in their portfolio, but then they want it each year.
Yeah.
And unfortunately, in a tax saving fund, even if you want to do something like that, you can't, because the money is locked in for 3 years.
Sure.
So I think where the DSP fund does well, and when I talk about against peers, it's really about looking at the fact that you have a set of 40 funds, and therefore anything which is in the top decile or quartile is actually doing much better than its peer group. And we therefore like the fact that it's a broad-based portfolio. It's got a consistent track record. Expenses are okay. Valuations are okay. They're not trying to hit the ball out of the ground for a super sixer. I think they're just in there saying we have a job to do. That job is to be able to deliver equity outcomes for investors who are coming in there, staying longer term. Let's just do that for them.
Okay, we'll have slightly running short of time. We'll have to breeze through the others, but
Sure.
You have 2 more recommendations, and one of them is PPFS. I want to rather talk about that.
Sure. So PPFS, Parikh, it was a PMS earlier. Then they had one equity scheme which has done phenomenally well, which we are all aware, PPFAS, long-term equity fund, managed by Rajiv Thakkar. And Parikh was known as the father of value investing in India. So, all other funds that I talked about and that my partner talked about here, they were all funds with growth-oriented approach, right? So if you want to go away from the crowd, PPFS is a fund house which is known as the #1 fund house which follows value style of investing, right? And in market over a 3, 4, 5 year period, there are seasons where sometimes growth performs and there are years where value performs. From that angle, I would, and they don't have a sector, it is sector agnostic, it is market cap agnostic, it is style agnostic. The only thing is they have value as the style, right? So every particular stock is cherry picked, and they do not like to pay more, for a particular. There is this discussion in all your shows also that you host that quality is very expensive today, right? So they have very clearly mentioned that we will never overpay for a particular stock. Amongst the 4 criteria that Warren Buffett mentions for buying a stock, the last one is price. And trees don't grow to the sky, so you don't pay a very heavy price even for the best stock on earth. That is the style they follow, and from that angle, I believe it is, although this particular scheme is new, but then they have copied the equity portfolio from their existing fund, which has a proven track record over 8-10 years. From that angle, I believe Parikh Tax Saver is a very good offering in a client's portfolio.
Okay, viewers, keep in mind, PPFS, the equity fund, has a mix of India investments and global investments, and I think what Nirav is trying to say that and correct me if I'm wrong, but that the tax saving fund is a mirror image of the India portfolio,
right?
And value style of investing. So that's the reason why, even though there's no track record, given by the track record of the fund manager and the fund house, Nirav is recommending or comfortable recommending PPFS tax saver fund as well. Your last recommendation, Vishal.
So I would say that the Motilal Oswal fund that he already spoke about may well be that last choice. Again, concentrated, growth stocks, largely driven towards larger companies at this point of time as well. So I think it's a good choice. The thing about ELSS funds though is that we keep telling investors that typically have just 1 or 2 in your portfolio. Don't spread yourself thin in that category. We've seen portfolios come to us where people who started off 15 years ago now have 10 different ELSS funds in their portfolio because every year they've bought the best performer, and they have 30, 40, 50,000 rupees that they invested because some of it was used up by insurance, EPF, etc.
EPF.
So they put like 30,000 rupees into each of these schemes, and then they have a hodgepodge of a lot of ideas. So I think typically for most people, just one ELSS fund is good enough. If you're just not comfortable with putting money in one name, which some people are, then maybe 2. So I think most of the time you'd never reach number 4 or 5 in an ELSS category, unlike, let's say other categories where there could be a lot of other options as well.
It's okay to differ, Nirav. Do you differ, or would you believe that best to have 1 or 2 limited
So
funds?
1.5 lakh cannot be broken beyond 2 or 3, right? But so so we have clients which are families where there are 10, 12 income tax files in a particular family. There you have the leeway of offering them in that particular family group more than 2 or 3 funds. But yes, I mean equity mutual fund itself is a very diversified product. So having 8 to 10 good equity schemes in any portfolio, no matter how big the size, is what you should be targeting at. And he very rightly said that we come across portfolios which were not professionally managed, and here are people 5-10-year-old portfolio with 15, 20, 30, 40 equity schemes. So then what you are doing is basically buying the BSE 500 index, and you bring down the returns of the portfolio. So every year chasing the top performer, as I had said in your last show also, if you buy the top performer every year, you'll never make money.
Yeah.
Right? So any of these funds that we have recommended between us 7-8 schemes, buy them, hold on to them for any period from 3 year to 10 year, and you'll not be disappointed.
Okay. Well,
You'll be getting return in the range of 12 to 14% compounding, which I think internationally is a very good return to look at.
Yes, optimistic. On that optimistic note, we'll have to wrap up this leg of the mutual fund show. But Nirav, Vishal, thank you so much, gentlemen, for joining in today and giving us your perspective. And viewers, I hope you benefited in some way with some options for tax saving. Go out after this show is over and send in the mail to your HR department. Thanks so much for watching the mutual fund show. Stay tuned to BloombergQuint.